Hello dear friends, today is Wednesday, December 11. Let's look at the charts for the euro and the pound sterling and try to make some predictions. As we can see, the European currencies spent the previous trading day under pressure. The pound sterling dipped briefly but recovered by the middle of the North American session and hit the weekly resistance level. As a result, the British currency remained range-bound. This suggests that its rally may continue, provided that today's data from the United States contributes to this scenario. Yesterday's data on German consumer prices was in line with analyst forecasts, with added to downward pressure on the euro. After all, easing inflation in Germany allows the European Central Bank to continue cutting interest rates. Today's US data was less important, but indicators came in well above market expectations, which boosted demand for the greenback. However, risky assets managed to trim their losses by the closing bell. Today's macroeconomic calendar is light with no major news releases expected from the euro area and the United Kingdom. All eyes will be on US consumer prices, a key indicator for the Federal Reserve in shaping its future monetary policy direction. Measured month-to-month prices are estimated to have risen by 0.3% from October to November. On a yearly basis, consumer prices are likely up 2.7%, a tick higher than the 2.6% annual rate in October and 2.4% in September. If inflation figures are in line with or below estimates, the Fed will most likely lower interest rates at its December meeting as planned. This will weigh on the dollar, allowing the euro and the British pound to strengthening. Core inflation data will also be released today. Economists expect core prices to gain 0.3% from the previous month and 3.3% from a year ago, after rising by the same amounts in October and December. The figures matching analyst estimates will underscore expectations for another interest rate cut by the Fed next week. Against this backdrop, the dollar is likely to come under pressure today, allowing risky assets to gain value. Now let's move on the technical analysis. According to the 1-hour chart, EUR USD false breakouts at 1.0501 or 0465 will make it possible to buy the pair. If data shows a sharp rise in US inflation, the euro is likely to fall to the 1.0430 level, where I recommend going long on a rebound to catch an intraday correction of 30-35 pips. A false breakout at 0539 will generate a sell signal, dragging the European currency down to 1.0501 and probably 0465. If bulls regain control of the 0539 mark in the first half of the day, short positions can be considered at 0565 on a false breakout or at 0593 on a rebound in anticipation of 25-30 pip correction. Regardless of the US inflation figures, the pair is unlikely to climb above 0627. Therefore, it would be wise to go short at this level on a rebound. Speaking of the British pound, buyers need to protect the middle of the new sideways range. A false breakout at 27.58 will generate a strong buy signal, with sterling rising to 27.96. If the price breaks through and consolidates about this level, it will pave the way for further gains to 28.27 and 28.58. However, this scenario is possible only if data shows easing inflationary pressures in the United States. At the level of 28.58, traders are advised to go short on the rebound, expecting a 25-30 pip move. Short positions at 28.27 and 27.96 can only be considered on a false breakout. In a bear case scenario, if the price breaks below 27.58, the volume of short positions will increase, with the British currency diving to 27.25, the lower border of the sideways range, and even 26.93. At this level, I recommend going long on the rebound in anticipation of a 25-30 pip correction. Going long at 27.25 and 27.58 will only be relevant in the event of a false breakout. Best of luck!